Okay, this week on the Business Owners Corner, I want to talk about health insurance a little bit because a lot of people we run across in my financial planning firm have an intention of retiring before they turn 65. 65, of course, is the age at which you qualify for Medicare, which is a very handy health program for a huge number of retirees around the country. But if you have the intention of exiting from your business before you turn 65 or stepping into retirement before 65, you might have to figure out what to do about health insurance before you reach that age. Typically, there are three options. Broad categories: you can keep what you have in some way, shape, or form. You can get a new policy through a broker, or you can get a new policy through the exchange, your state exchange. There are also health share programs out there. I won't comment on those today, maybe a topic of a future video. Option for some people, but they're not bona fide insurance, and I'm kind of reluctant to suggest them at all. In general, you've got three options: keep what you have, get a new plan through a broker, or get a new plan through the ACA Healthcare Exchange, American Affordable Care Act exchanges that were set up by the states a few years back. So keep what you have. Well, if you're someone who has obtained health insurance as an individual, but then has reimbursed yourself through your business, well, guess what? If the business goes away, you can just keep the same health plan. The premiums might go up a little bit, but you don't have to get a brand new plan if the business goes away. That's helpful. What might be challenging about that is the whole reimbursement portion of it. If you own an S corporation, if you're a 5% or greater owner of an S corporation, you can reimburse yourself through W-2 for your healthcare premiums and deduct them on your personal return, which is very helpful. If you're someone who has health benefits and a health plan set up through the business that you and your family are participants in, well, you might be able to remain on the plan after exiting from your business, transitioning into retirement, but it might require that you go on COBRA. COBRA, of course, is the program that allows you to remain on the same health insurance plan offered by an employer for up to 18 months after you leave. Depending on how your plan is set up at the business, if this is the route for you, it may be more expensive because COBRA allows employers to charge 102% of what the policy costs are to COBRA participants after they leave because of the operational headache of keeping track of X employees. So it might be a little bit more costly, but at least it allows you to stay on the same plan. And if you're approaching that date, let's say that you're uh, uh, getting out of your business entity when you're 63 or 64, maybe that's the path of least resistance. Stay on the same plan through COBRA. Option number three is get a new plan through a broker. Health insurance is sold through brokers and the marketplace, which we'll get into in just a moment. You pay the exact same amount for the insurance, regardless of whether you go direct to the provider or you get it through a broker. And this stuff is complicated enough to where it's almost always better just to go through a broker because it's not going to cost you any more. They make a commission on selling the product, but that's not that big of a deal at the end of the day. They're able to guide you on the ins and the outs of the plan and find the right fit for you. So you can find a local health insurance broker. These professionals are licensed by the state, so you need someone who can operate in your home state. But the benefit of doing that is they may be able to offer you plans that are not offered through the marketplace. The markets are different in the private insurance market versus what's available through the marketplace. So a broker might be able to find you a better deal, and it's worth getting a quote from them if that's the best route for you. Now, the thing that we probably get the most questions about when for clients who are going through this kind of transition is, what is the marketplace? Why do I care about it? The marketplace was set up by the Affordable Care Act, again, a few years ago. And if you obtain a plan through the marketplace, which you can do without a phone call, 100% online, the marketplace website is going to ask you what your income is or what you expect it to be. And then they're going to charge you a premium for the health plan that you choose based on that income. And so if you're someone who is selling a business and you're not going to have any taxable income at all, you might qualify, depending on the tax repercussions of the transaction, If you don't have any income at all, you could qualify for what's called an ACA subsidy, an Affordable Care Act subsidy. If you're a low income person, that means that the government could pay up to 100% of the cost of a healthcare plan, around 100%. I'm not sure on the specifics these days. The point is that there are federal tax dollars that subsidize the cost of these premiums, and the amount that you pay depends on your income. So if you're someone who's transitioning away from your business into retirement before the age of 65, well, some proactive planning could save you a whole boatload on healthcare premiums, because you might want to intentionally suppress your income and avoid triggering any interest income, capital gains, distributions from retirement accounts, anything under the sun, because if you do, your healthcare costs are going to be far lower. So you go to your local state's exchange, fill out the forms, and with some proactive planning, might be able to limit the amount that you're paying out of pocket in terms of healthcare premiums. Now, one thing to keep in mind here is that if you go that route and then you file a tax return so you go that route of saying you're not going to have any income whatsoever, they don't charge you any premiums for your health plan because your income was zero based on the form that you filled out. And then you file a tax return for that year that says you have $250,000 of income. Well, guess what? You have to pay those subsidies back when you file your tax return. So don't intentionally do it just when you fill out the form disingenuously. Be accurate, but through proactive planning, there are ways to suppress your income levels and capture some of those premiums. If your income goes up the following year, there's no clawback that I'm aware of getting taking back some of the premium subsidies from prior years. It's based on the tax return that you're filing for. So those are a couple thoughts. If you're someone who's stepping into retirement before the age of 65 when you're eligible for Medicare, primarily there are 3 ways that we can obtain insurance. Those are my thoughts on each of those 3.